You have questions, we have answers. This is Jane Muller.
And this is Ken Muller. Welcome to our show, all about real estate with Ken and Jane. Today, Jane, we're going to do a November market update in view of the Fed's most recent rate hike. And we're going to look and see how the market is responding and looking ahead to what we can expect. So we should start with some positive news. The October CPI, Consumer Price Index, came out, and it showed that the rate declined a little bit. It dropped down to 7.7%, which is a little bit less than it was in September, which had reported 8.2%. So that means the CPI, which is the inflationary indicator, has come down. Most consumers are not going to feel that effect because it's very minor, but it's in the right direction down, and the perception is good. So there's hope there's hope and prayer that the Fed, for their next and final meeting in December, will either lessen the rate hike or maybe perhaps let it go, which would be
that would to be determined. Before we start, right, I have to share this. Ken is so excited about today's show. Why? It's a data.
Oh,
He's so excited to
Absolutely,
talk about the numbers and everything. Yeah, okay.
And I think the listeners are too. They want to know how the price is compared to the market trends and the 2020, 2021 versus the inventory now, and also the median sale price. So those are all figures that are.
You know what, Ken? That's debatable. Some listener will be like, you deep in the data. Don't tell me what you think. Just give me the facts.
Well,
other people like myself, I just want to listen to the conclusion.
Well, because everything is numbers. You look at like the sports, the Jets win-loss record, right? Those are all positive. That's all positive data. So
exactly.
Giants too. So let's go back and let's look at 2022. The beginning of January, the market was still red hot. So it's interesting. A lot of things have happened since January. At that time, the effective Fed rate was almost like zero.
Yes.
So that's why the interest rates were still relatively low.
At that time, I remembered some of my clients, they said they got 2.5. I heard some people even say below that. I was said hard to believe, but the rate that time was extremely, extremely low.
Right, and the Fed was buying tremendous amounts of bonds still, so there was a lot then. So the rates were at all-time lows. So obviously the market has changed, and the main effect, one of the most major effects of the interest rate, the Fed hikes, are that the banks in turn raise their rates to the consumers.
Yes.
So if we took a $600,000 house back in January, Jane, and in your mind, what does it do, the rate hikes, what does that do to the affordability of that $600,000 house if you're buying it in November of 2022, 11 months later?
Ken, that's a huge difference because I remember, right? I remember in June, not even now, right? In the November, in June even, at that time, the rate went up to, I think, 6% first time, the below 6, 5 something. They just touched the 6 that time. And we had a contract already signed, accepted in the attorney review. And we finished the review, I remember very clearly, on Wednesday morning, just before the Fed, Tuesday or Wednesday morning, just before the Fed announced it. And we held up the review. By that night, because the buyer took the contract after we under contract, they took that to the lender. At that night, they found out the monthly payment went up $800 because they were not aware. They're still using the old, the approval which they had. By the way, the approvals, most approvals can be 3 months or 6 months, right? At that time, is in June, so he got his approval in March and April. So that was still relevant, right? But he didn't know that night he got shock of his life, even though we're under contract. And then they came back, they called me really, late at night, 11 o'clock at night. Obviously I was asleep. So in the morning, I got the message and they tried to get out. Think about it, what that did to the buyer and the seller. The buyer loved the house. At the end of the day, $800 more a month payment. That's really put them over the edge. And so does the seller. We have had the contract. We had a multiple bid, and that happened. So can you imagine from that until today? I mean, it has to be much, much more. So when the interest rate go up, a lot of buyers no longer qualified for the mortgage, what they desire. So they probably have to reduce the bracket, what they're looking for. Used to be, say, they qualified to get a mortgage by a house 700, now become 6, or used to be 6, become 5. And then there's a triple down effect. And some buyers, even though they qualified to, even though with a high rate, they can qualify, but they don't want to sacrifice their lifestyle and worry every day, to paying how they're going to pay the children's, the violin lessons, for example, and how if anything happened to their job, what's going to happen to their family, right? So that's a huge, huge impact. Yes.
Right. And it's even more pronounced, the additional monthly rate increase is even more pronounced when you compare January of this year to November, because the rates have gone up and up significantly. So it's much more. You're talking about more than doubling. I think the current rates on a 30-year are around 7-ish, we'll say, because they change daily, it depends on the down payment, depends on the credit rating. But for a borrower with a 20%, 25% down payment with the preferred credit, it's about 7.1 or so on a 30-year. But that could change that's going to fluctuate very.
Yeah, but so, compare with the February 2.5. So
you're
that's
talking
huge.
So on a purchase where you're borrowing 80% of a $600,000 purchase, you're talking the additional interest rate you're paying every month, because you're talking several $1,000s, which is huge. I mean, that used to be a mortgage payment in and of itself, and now you're talking about increasing it by almost carrying 2 homes.
Yes, that's right.
So that's what's caused. But nonetheless, the Fed chair, Jerome Powell, said that the most important thing for the economy is inflation. He quoted something at a recent speech: without price stability, the economy does not work for anyone. And I think that's true, because with inflation, you have the raise in the food prices, consumer products. So if that keeps going up, I mean, the housing is one aspect of the economy, but on the macro level, that's why the Fed is determined to get that inflation down.
I totally agree. I mean, a lot of people in the U.S., we are very lucky. Unfortunately, we don't know what a crazy inflation feel like, right? I still remember year 2000. My mother and I mean, after I finished my master's degree, I want to reward myself. So my mom and I went to a long vacation. We went to Turkey. At that time, right, I remember that McDonald's, right, the burger is like a 13 million or 20 million or something. I thought 13, 20 million for a hamburger? Mm-hmm. Yeah. And then I remember that time there was a note, $250,000. I asked my friend, I said, hey, $250,000, what that I can get? And they laughed. They said, yeah, you can go to the bathroom with that, because here we charge bathrooms.
But at least you're a millionaire.
Exactly. But truly, a lot of people in U.S., right, we don't know what's the inflation, worse inflation can do to people.
Yeah. Well, we're starting to see it in the food prices. Last time I went to the grocery store, when roast beef was at the ShopRite, it was like $19, $20 a pound.
But I can't think about it. I mean, 2000, you go to Turkey, could be $20 million a pound. That's really. I mean, I understand it's painful, and we all go through. I mean, every day, every time I go, even buy egg, right? The price is so high. I mean, we understand, but. I guess it's hopefully the short pen can give us a long-time healthy economy. Yeah,
So that's the Fed's philosophy. When the spending and the is getting out of hand, they raise the rate hikes. When the economy is not doing well, meaning there's a lot of jobs, to stimulate the economy, they'll lower the interest rate. So that's they either want to cool it or they want to stimulate it. Those are the two things.
But I think, Ken, I once again, I'm not here qualified to give my 6 cents to what the Fed should do. They are right, they are wrong. But just put my woman, common sense head here, right? If you are in the if someone's sick, right, you have a very high temperature, the doctor give you some medication. If the medication doesn't work, you don't give the medication. Sometimes maybe give a little bit room to let the medication work itself, what I mean with this, the rate was increased so deep and so fast. So it's just like,
Right.
I mean, in 6 months, 7 months, it went up 6 times, right? It's just, and so deep increase. It's just almost like in April, you plant some plants out there, and in early May, there's suddenly nighttime temperature drop below 20 degrees. And whatever, it's just like a shock the system.
But I think the Feds looks at it a little bit differently. They're looking at how much they can shock the system based on how resilient the employment data is. If they were to start to see sharp declines in unemployment and jobs figures, then they might cool back. But I think their analysis is that the U.S. economy is strong and vibrant enough to take these hits and still be afloat. But they're constantly, carefully monitoring that data as well as the CPI, because that's a fine balance. They want the inflation to come down, but they don't want to necessarily put us in a recession.
Soft landing, he said.
Yeah. No, I think it's more a delicate balance between the two. They have to balance both of them. So it's very. And I just want to share another interesting data piece is typically during a recession, the last 6 recession periods that were classified as recessions, the interest rates actually went down.
Yeah,
they went down, and I have the data. We don't see because at that point the Fed is saying, "Oh, we're in a recession. We need to do help out the economy, so we're going to give the banks a hand and lower our rates to them, and they can lower their rates to make." So it's
So hopefully, once again, I rather pay a higher rate than the recession. So I don't know which one I pick the more favorable at this point.
It's a fine balancing act. All right, why don't we take a short break, and we'll be right back after these messages. Okay, welcome back to our show. So, Jane, let's tie in these economic data on the macro level to the Central Jersey MLS and look at how the interest rates and how the listings have been doing on the last, 2020, 2021, and 2022. We'll take a look at the active listing inventory, comparing those 3 years, and then we're going to look at the median home sale price.
You know what? I'm glad, Ken. Yeah. First half of the program, you talk so much about economy and the interest rate. I feel like I went back to my college. Now let's talk about something I know about. Let's talk about real estate.
Well, I would say something that you know about and that you live and breathe every day.
That's right. That's really exactly
all right. So we saw a decline from 2021 to 2020. And likewise, from 2022 to 2021 in the number of active listings, if you take the active listings, just to give the listeners a broad-based figures, in 2020, the active listings from January through November were in the 4,000 range. Last year, in 2021, they went down roughly anywhere from, they were like 40% down. They were maybe 60% of what they were in 2020. And then in 2022, the active listings as compared to 2021 went down again another 30% or so, 20 to 30%, depending on the month. The data is. Now, if we take November of 2022, just to give the difference, there are about 1,745 listings this November. Compare that to 2 years ago.
October, you mean?
I'm sorry, October, right.
Yeah. Mm-hmm. November, we're still in November.
That's right, we're still in November. So there's about, so October was about 1,900 listings this October. 2 years ago, in October 2020, you had almost 4,899. So you can see the disparity in the drop is really quite dramatic.
Yes, absolutely.
So that's really the first point, that there's been a downward trend. Which is understandable. That's expected. That's nothing earth-shattering. You expect that because of the reasons the buyer pool tightens up because they're not able to borrow, and some people may sit on the sidelines and say, you know what, if I can't afford that $500,000 or $600,000 house, I'm not going to drop a bracket and get a less expensive house. I'm just going to wait it out on the sidelines and just wait till the interest rates maybe come down, possibly in the next 6 months or so, or in the future, and you get. So that may be a reason the buyer pool has reduced itself.
Yeah, I have to say, Ken, when the inventory dropped down so much compared with the last year and the year before, it is good news in itself. not for real estate agent, obviously, but it's good for the market. Why? Real estate market is always supply and demand. I always tell people, when we think about real estate, what they say, location, location, location. Based on my own years of experience, I don't think that's accurate. I think the number one element for the real estate, instead of location, I would say timing. Why is it timing? It's truly a supply and demand. If it's more demand and then less supply, and the price go up, like we've seen in the past, right? However, now because the buyer pool decreased because the sharp increased interest rate we just discussed, all this just last half, of our show, and the buyer pool has dramatically reduced because the sharp increase rate. That's what Fed tried to get anyway. That's what they try to cool down the market. But why the market didn't free fall yet? That's because they lack less supply. Say if it's a lot of supply and a lot of lack of demand, that's what happened to 2010 and 2011 and 2012. When you walk on the street, you can see 3-4 listings on the same street or that street, right? At that time, I remembered when I show client house, I have to literally go through a lot of homes to search, right? And then to try to get a top 8 home or top 10 to suit them, so to show them the house so they can choose from. But at this point of time, even though the demand reduced dramatically, but the supply decreased even more, so that's why I keep the market still stable.
That's why it's not in free fall, and otherwise it would really fall drastically. But right now, we're going to cover the median, but it's right now, from what you're seeing in your listings, because you do the residential, the market prices may have
came down.
The resale, list prices may have come down, but it's stable. It's stabilized.
Yes,
it's not in a free fall mode where it's dropped like 20%, 25% as compared. It may have dropped a little bit from the highs, but again, you got to remember a lot of the comps we're looking at are comps for homes that were overbid. So when you see the sold prices, if you use that data, it's really, if you take that into comparison, the prices for existing homes on the market now are still very, very stable and high, because the data that they're using are homes that were bid $30,000 to $50,000 over list price.
You know what, Ken? I totally agree with you. If you look at 2019, for example, right? 2022, before February, right? Before this COVID started. So look at 2019, for example, right? The market last 3 years increase, in my opinion, average 30 to 35% average, what I see, right? Some people may increase the 50, 80% if you bought really low, right? But depends which year you bought it. But generally speaking, is 30-35% increase. Today's market, I think, since the rapidly increase in the rate, I think the market may went down maybe 5 to 10%. But if you think about it, if average went up 35%, you went down 10%. You're still 25% higher than the 2019. So if you sold, I remember very clearly at 2019, there was a house in East Brunswick, split level in Lawrenceburg area, right? They closed in February, but the house was sold in December 2019. So they take a 2 months closings. February they closed before COVID. That house is really nice. It's a split 4 bedrooms, 3-4 baths, and very nice house. They only closed about $425,000. But now today, in my opinion, that house will easily get $550,000. Easily.
Which is a dramatic increase.
Yeah.
So that's the conversation, I think, as an agent, a lot of agents have to have with their sellers. They have to educate them and put it in comparison to 2019. Don't compare your house to your neighbor's house from 6 months or a year ago. But if you look at the market the last 3 years, and then they'll be more comfortable with the recommended list price, knowing if you can educate them and explain to them the market, took such a dramatic spike due to the interest rates. But if you look at the historic comparison, it's still up considerably.
Yeah. Another thing is a lot of sellers said, oh, Jane, we're not in a hurry. Why don't we sell next year? Why don't we sell year after? We just want my price. But the market is going downtrend. This is just natural. That's just a cycle. If you wait for next year, because as I said, the market went up 35%. If you sold between January, the houses sold January to April, right? Mm-hmm. But if you wait for next year, we'll already come down 5 to 10%. Next year, if the interest rate is still coming up, maybe we're going to lose another 5-10%. So by delayed listing, in fact, may reduce your your selling price. If in my opinion, if you could sell your house this year, and in my opinion, potentially you should get more compared with you sold in last year, the year after. That's just my opinion. I mean, you may disagree, but that's just my opinion. But once again, it doesn't mean you have to pack up and sell, because you have to see what's your life cycle, right? What would you want to do with your life? Getting the most money may not be the first priority of a lot of my clients, right?
It may be convenience,
yes,
or lifestyle changes, or when their new house is going to be ready, be built.
Yes,
so.
Or when they're going to retire, if they're going to retire in 1 year, 2 years, right? And they don't want to rent, they don't want to pack up, right? So, and also, if you have to buy another house, it's the same thing. If you sell high, you buy high. You sell low, you buy low. So at the end of the day, it's most likely wash. So that's why the inventory is low, Ken. That's one of the reasons.
Yeah, and let's tie in now the historic medium sale prices. We have that actually from 2018 through 2022, and that really exemplifies your point. Even if we pick October of this year, the median home sale price was $416,000. If you go back to your 2019 in October, again, this is Central Jersey MLS, median home sale price. Back in 2019, the median home sale price was only $320,000. Mm-hmm. Again, the data is this is the all averages, but that base highlights your example that the home you mentioned in East Brunswick would have gone up considerably in that period from 2019 to present.
Yep. You see, that's you and me. That's a yin and yang. You like to look at the data. I just
you know it from the experience,
from
and the data just reinforces what you're saying. So out of all this data, it shows that the highest home median price occurred in 2022, June of this year, at $433,000, and then it's dropped every month since then, and it built up to that point. And I think we can determine why June of 2022 was the point of the highest median home sale price, because, like, you want to explain.
Yeah, I think that's, in my opinion, is 3 reasons. Number 1 reason, if you close in June, so the contract must draw in March and April. So that's really the interest rate that time is very low. So the lowest point, 2.5 kind of rate is very low. Second reason is they already increased once, right, in April, right?
In March.
In March, they went up a little bit. So that enough to scare a lot of buyers sitting on the fence. They say, oh my God, they increased the rates. That's better buy it before the rate going further up. So that's created more demand in the buyer side. And thirdly is March and April and May is a traditional spring market. So traditional, a lot of people looking at that. So I think the traditional spring market is the least impact. I think majority was a low rate. And the secondly is more fear the rate going to go up. So they got to buy today.
Right. So the concern about future rate hikes further stimulated them to buy now. And then, like you said, the offers are made in March and April. The rates are locked in then.
Yes.
So they took advantage of very low rates.
That's right.
And the closing is typically 60 days
or 90 days
later. So that's why that prompted the median home sale price in June to be the highest.
The highest one. After that, as I said, the inventory is still record low. So that's why it helped the market to stay with the price point.
Okay, we're almost out of time. So if the listeners are saying, well, should I sell now? You kind of touched on this, but the general answer is that it depends. It depends on your circumstances, your lifestyle needs. From a pricing standpoint, now is as good a time as
time
the
is
future because of the uncertainty of future rate hikes, and the market is still home prices are up 20-25% as compared to 2019 in Central Jersey.
That's correct.
All right, that's good. So we're out of time. We'll see everyone next week. Please enjoy the rest of your weekend.
Thank you.